Last week, the major markets were filled with many new all-time highs. The Nasdaq, Dow Jones Average, S&P 500, and the MSCI World Indices all registered new all-time highs as they added to their year-to-date gains. The Emerging Markets Index was the lone major market index that ended lower and continued to remain negative year-to-date. Last week was a full week with numerous economic reports, earnings releases, and a midweek FOMC press conference. The economic calendar saw multiple beats, with the ISM Manufacturing Index coming in at 60.8%. While this was below the prior month, it was ahead of the anticipated 60.3%. Wednesday's ISM Services version of the index reported a new all-time high for the index at 66.7%. The running theme for both ISM indices was the continued supply chain strain and how it impacted both the manufacturing segment as well as services. These indices help provide an overview of the two segments, with a reading above 50% indicating that their respective segments of the economy is generally expanding, while a reading below 50% indicates that it is generally contracting. Both manufacturing and services indices highlighted the growth in the backlog of orders, with an all-time high in October for the services backlog of orders, and a minor decrease from the September all-time high in manufacturing backlog of orders. Meanwhile, inventories remained extremely low, with the manufacturing index inventories actually in their 61st consecutive month at a level considered too low and a positive for future production growth. Later Wednesday, Fed Chairman Jerome Powell held the FOMC Press Conference, which provided a number of noteworthy comments. Ahead of the meeting, the FOMC statement announced that they would reduce the monthly net asset purchasing by a combined $15 billion per month, representing the beginning of a move away from stimulating the markets. In his own words, he said,
"So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter."
The remainder of the press conference is available on the federalreserve.gov website. Finally, the week closed out with the release of the October non-farm payroll report, which saw 531,000 new jobs added last month, and the unemployment rate dropping further to 4.6% as the economy continues to move past the pandemic.